Hello and welcome. You're watching Buy Now, Sell Now here at ET Now. And it's looking like the markets have recovered quite a little bit.
Absolutely. Absolutely. This is the show where we also answer your stock-specific questions, and next 1 hour is going to be all about your stock-specific queries and also management commentaries, because we are in the thick of earnings season. We'll be having a lot of managements answering their quarter results question. But before that, let's us quickly flash the QR code on the screen, because this is the way you can reach out to us. And you can send across your stock-specific questions, write on the name of the stock, the price at which you bought it, and the price along with the holding duration. Accordingly, we'll get you a technical or a fundamental take from our experts. But before that, Meryl, what's happening in the market? There is a recovery. We are seeing Nifty and the major indices as well as the broader indices recovering, but still not yet fully recovered the way we want it.
That's right. Nifty, if you saw in the beginning, it was up, it was down about 0.3%, 0.4%. It's looking quite flat now, down only 0.05%. Nifty IT as well, down only 0.25%. Nifty Bank only down 0.5%. Seems like we've seen quite a recovery in the broader benchmark indices. But let's take stock of where the broader indices are as well. The broader market is also seem to be performing in a better fashion than where we started off the day. Nifty mid cap is down about 0.1%, even below that. Nifty small cap also down only 0.15%. If we take a look at all of the sectoral indices, then Nifty auto seems to be bucking the trend, up about 1.5% in today's trade so far. Along that is Nifty media, also firmly in the green. Among the losers, however, we've got Nifty Bank leading the pack of laggards over there. Along with that is Nifty Capital Markets, Nifty IT, Nifty Energy, Nifty Communications. All of these sectoral indices are firmly in the red. So it still looks like the broader market is dominated by the reds, and we've only got maybe 1 or 2 sectors in the green today. If we take a look at some of the top losers in today's trend, Dr. Reddy's is one of those after the company's first quarter results have come out a little bit weak. Kavita, where do you see the broader markets moving today?
Absolutely. We'll get back on that, but it's time to, switch to our management commentaries, and let's shift focus to Waaree Renewables Technologies, where good set of numbers coming up. Revenue is almost at 924 crores in Q1 FY27 versus 603 crores in Q1 FY26. Also, PAT, we saw year-on-year basis 38% jump. We're also joined by the management, Mr. Manmohan Sharma, CFO, Waaree Renewables, to answer all of the questions. Hi, good morning, sir, and welcome to the show. So you've delivered a massive 53% year-on-year top-line growth. Congratulations for that. But revenue dropped sequentially compared to Q4, obviously. Wanted to understand, is this dip purely down to seasonal factors, or are you noticing any execution delays?
I would like to mention some of the key highlights for the quarter. We have successfully acquired 55% stake in Associate Power Structure. The company is in the T&D business. So by acquiring the stake in the Associate Power, we have created value chain in the transmission business as well as. So along with my solar EPC business, we will be moving in the EPC of T&D also. So by integration of these two entities, combining will create a value chain for the stakeholder. And now coming back to your question, that we have grown significantly. We have on a quarter-on-quarter basis, we have improved our margins, but on a quarterly basis, if you see that we have improved 53% our top line, and our EBITDA is also 18.77%.
Understood, Mr. Sharma. But with rapid scaling in EPC, how are you holding the line on margins against raw material cost fluctuations?
Yeah. So while executing the order or while taking the order, we prepare the estimated budgets, and then we add margin, which is like threshold margin for our executing any of the projects. So by doing so, we offer the prices to the customers, and we take care that the margins remains intact. and go in while calculating this costing, etc. And we keep factor on like fluctuation, market conditions, and the increase in raw material cost. That factor we consider while executing the order. We take care that these order get executed with the disciplined manner in a timely completion of these projects. Along with the financial discipline, we keep all three parameter together, then execute the order, so that it gives a like consistency margins over a period of time.
All right, Mr. Sharma, you are sitting on a massive 5,300 plus crore order book, split roughly 50-50 between EPC and T&D. How much of this will convert into top line revenue within FY27?
So, like for the current quarter, as I mentioned, we have already achieved 924 crores. Last year, if you see that EPC business itself has delivered 3,321 crores of revenue. Similarly, for the T&D also, if we go with those numbers, this is around 1,900 to 2,000 crores of the revenue. So, combining these two entities, for a limited period of 10 to 12 days only, because we acquired stake on the 18 June, completed this acquisitions. So in the coming quarters, you will see that the increment or maybe increment in the revenue and overall mix of the this our revenue, combining the T&D business and whatever the EPC project which we are executing, along with we have another two set of stream, that is O&M and IPPs within our company. So going forward also, combining the execution of 5,300 crore of order book, which are likely to get executed in the next few quarters. So along with these, the existing order book, what we carry 5,300 crore, plus the order which are likely to receive in the next few quarters, combining all these, we will execute during this financial year.
Right, Mr. Sharma, that's that on the order book. But you also recently acquired a 55% stake in Associated Power Structures. Tell us, how quickly will this acquisition start contributing to your bottom line? And are more acquisitions such as these on the horizon for you?
Yeah, see, this is established company over a last 2 to 3 decades. The company is in the transmission distribution and really excellently well. They have good amount of order book, and whatever that they have this executions also there in the previous years. So there is nothing like which we need to start once again. It's a combination of these two entity, whereby the cross like whatever the T&D projects are there, which can be combined with our against EPC, solar EPC, so vice versa. So we can get more and more of T&D business under that entity, and similarly EPC business and solar EPC will be in the Waaree Renewable Technology. By combining these two entities, there is a lot of strength will come in for the business in going forward.
Right, if we have to talk more about the EPC opportunities, last time post-results management had said that they are evaluating data center EPC opportunities and has received inquiries as well. But no firm orders have been secured yet. Any progress on that front?
We are also the same. We have already actively looking all kind of data center opportunity. That is what is progress in this quarter. Apart from that, we are also doing the best EPC. So we have certain orders out of our combined order book of is Waaree Renewable Technology. We have base orders also. So there is a good amount of progress on the base order, and in the coming quarter we should get something from the data center as well as. So there are 3-4 lines which has been created for this Waaree Renewable Technologies.
Right, so with the recent wins like the 15-20 megawatt hour BESS order, battery storage is becoming a key driver for you. How significant do you expect BESS to be in your overall order mix over the next 2 to 3 years?
So BESS is a very significant combination of while for the solar or the renewable also, whatever for the grid stability, because in the daytime you can there is a lot of power is get generated, and that is to be evacuated in the night. So BESS is the one of the system, but like where you can store the power and evacuate in the night. So going forward, you will see more and more project RE projects which will be combined with the BESS, so that that grid stability will be there. And there is a like we are staging this order pipeline of around 25 gigawatt domestically, as well as around 11 gigawatt internationally. Similarly, for T&D business also, we are chasing around the 20,000 crores of worth of order pipeline. So the combining this along with the best, there is a significant opportunity for the company to have a EPC business in these entities.
Mr. Sharma, last question before we let you go. Your current O&M portfolio stands at approximately 1,054 megawatts now. Since you mentioned plans to expand by taking on third-party O&M contracts as well and offering new services there, what are your specific growth and revenue targets for this segment over the next year?
So as compared to my EPC revenue, this is because my EPC revenue is going up in percentage terms, it will always be smaller. But however, whatever the projects which we are completing, we want the O&M for this company, so that there will be a revenue stream for this company. So our efforts are there to get more and more O&M orders, not only from the project which we have already executed, from the third party also, as you rightly mentioned. So that strategy is also working. And going forward, we see that the O&M portfolio will also expand significantly. And apart from that, we have IPP revenue also. So IPP revenue we are developing certain project under our subsidiary. Land and connectivity is also there in few subsidiaries. So those projects will also get developed going forward.
All right, Mr. Sharma, with that, we'll let you go. Thank you so much for being with us here on ET Now. But with that, viewers, we'll slip into a short break right now. But don't go anywhere. We've got a lot more on the other side for you. We've got another management as well. Smartworks is coming up next, right after this break. Welcome back. You're watching Buy Now, Sell Now with me, Meryl D'Souza and Kavita Thaplayal. And before we get into the queries, actually, as promised, we've got the management of Smartworks on board with us here to decode their first quarter set of numbers. Now, if you take a look at the numbers really quickly, revenue was up 44% on a year-on-year basis for the company. EBITDA also up 43.5%. Net profit was at a 13.1 crore loss, however, and margins as well was slightly down, about a 23 basis points. We've got Mr. Harsh Binani, co-founder and executive director of Smartworks, right here with us to decode these numbers. A very good morning, sir. Thank you so much for joining us here on ET Now.
Good morning. Thank you very much for having me this morning.
Right. So let's just get right into it. So you reported a good set of first quarter numbers. Revenue saw a strong growth, and out of the guidance for FY27, you've already achieved 30% of that in the first quarter itself. Can you tell us what were the main growth drivers for the strong growth, and do you still stick to the 1,796 crore full year FY27 guidance?
We are in middle of a mega trend playing out in front of us. There are three structural shifts which are happening together. India is, of course, becoming the execution engine for world's largest companies, and flexible workspace is taking share from conventional office spaces. And within that, what you're seeing playing out is scale is consolidating towards the strongest platform. Smartworks, as the category leader, is disrupting the space, and it is quite visible that we are sitting right at the intersection of all of these three trends playing out in front of us. And just to give you a perspective, the office market grew at about 6%, Flex grew at about 23 to 25%, but Smartworks actually grew 44%. So we are just not participating in this mega trend, we are actually gaining market share. And if you look at our numbers, our revenue grew 44% quarter on quarter. Our EBITDA grew 74%. So for instance, last year, every 100 rupees of revenue was generating about 16 rupees of EBITDA. Today, that is generating close to about 20 for us. And our PAT practically tripled. And this is happening right in middle of a heavy capex cycle. our return on capital continued to remain stable at 21.5% in spite of the heavy capex deployed. And we are seeing a very, very promising growth ahead of us.
All right, Harsh, hi, this is Kavita also joining in, and good to see you once again back on the channel. Well, looks like the
Thanks,
mega
Kavita.
trend is working in your favor, but I also wanted to understand, in terms of seat additions, what's the number like in Q1 FY27, Harsh?
Certainly, as you've seen, our platform is scaling the fastest. And today, if you look at the evolution of the company since our IPO 5 quarters back, today all the large developers are on our platform, whether it's DLF in Gurgaon, Raheja in Hyderabad, Panchsheel, Tata Realty, Hiranandani. And what you're seeing playing out is a habit shift. A lot of the companies earlier wanted to own their office space. Then it gradually evolved into leasing that space. And now what they want is managed office space, which is where Smartworks is right at that intersection. And in terms of our guidance, we had earlier guided that we'll be adding 2.5 to 3 million square foot every year. We are well past that mark now. In this quarter, we added close to about 4 lakh square foot. And we are very pleased to announce the world's largest campus, which is in Pune, Kharadi, which is also going to go live in H2. So in H2, you're going to see two big mega campuses, one with Hiranandani Group and the other with Panchsheel Group, ramp up our numbers. So by the end of the year, our 10 million square foot operational will jump to about 13 million square foot. And that is largely happening because of this unique model that Smartworks has developed, right? Which is to lease really large campuses and fill them up with really large enterprise clients. And last year, as you would have noticed from our large signups, not only are we getting large enterprises to continue to grow with us, but they are also expanding and scaling up with us across multiple cities. So from that perspective, demand drivers will continue being large GCCs, large global enterprises, and Indian conglomerates who not only grow with us, but they also expand with us.
Right, Harsh. You also indicated mature centers currently operate at a 92% level of occupancy. Can you tell us if is that the level of occupancy you are targeting for the full year FY27 as well, or is there any headroom for growth here?
Our mature centers occupancy has been a big strength for the company, and it has not been a strength today. Right since COVID days, our mature occupancy has remained very stable and has been a major source of operating leverage. Typically, if you look at the industry, mature campuses operate at about 80 to 85% range. Smartworks, because of its large enterprise signing up 4 to 5 year contracts, sees a very stable occupancy trend. So we continue to expect that the mature occupancy will remain at these levels and continue going up. But what will happen alongside that is that our newer campuses, they will ramp up their occupancy even quicker. And one aspect to note is that back in the day in 2021, our average campuses used to be about 2 lakh square foot. Today, they are at about an average of 5 lakh to 7 lakh square foot. We are taking precisely the same time to fill it up. And that is because of which you are starting to see our margin numbers go up meaningfully. Last year, our margins were at about 16%. This quarter, they are already at close to about 20%. So as a result of our mature center occupancy going up, and our newer centers ramping up quickly, you will see this dual engine playing out, and our margins will continue to increase as a result of that. But the true hallmark of our business is not only enough rapid revenue growth and margin growth, it is in the cash flows that the business is generating. And here is where you will see Smartworks really shining.
Sure.
And in spite of the heavy capex, our ROCE
Right.
continues to remain very strong.
Fantastic. Harsh, we are slightly pressed on time, so I'm going to just combine 2 or 3 questions in one. So first, ROCE remained above 21% despite heavy investments. Just want to know what minimum ROCE threshold do you target before committing to any other major expansion cycle? And also, because you're talking about mega trends and transition, which is working in your favor, how is AI changing office space requirements? Are clients demanding more collaboration spaces or fewer seats?
No, certainly. Our ROCE threshold continues to remain the same. And like we had guided the market earlier, our ROCE was at about 16%, and we see enough headroom over the next 2 years for this to double. In spite of the heavy capex cycle, I'm reiterating our ROCEs has continued to remain stable, which shows you that capex grew by 70%, yet your ROCE remains stable. So you will only see these numbers continuing to go up. AI presents one of the massive opportunities ahead of us along with GCCs. A lot of the new AI offices that we have delivered has more square footage. They demand more collaborative space, And of course, more square footage means more business for us. And particularly GCCs will also be a big mega trend. What was 15% of our revenue last quarter is now going to inch up to about 21%. So both of these will continue to drive significant new demand for us. So while on one end, we are firing because a lot of our existing clients are demanding more space with us, but we still continue remaining very underpenetrated. Can you believe only 250 of the Fortune 500 companies have their GCCs in India? So there is a lot of headroom for growth over the next 2-3 years. And we, as market leaders, believe are well positioned to capture this growth ahead for us.
All right, Harsh. So a lot of optimism coming your way, a lot of headroom for growth as well that you're seeing going into the next few years. Thank you so much for joining us here on ET Now. We'll speak to you very soon, very quickly.
Thank you very much for having me.
With that, viewers, we'll slip into a very short break, but don't go anywhere as we've got the most awaited part of our show right up next on the next segment. And with that, we'll have a QR code flashing on your screen right about now. So send in all of your queries that you want us to address in the very next segment right after this very short break.
Welcome back. You're watching Buy Now, Sell Now, and next half an hour is going to be all about your stock-specific question. The number where you can send us your queries is flashing on top of your screen. That's a WhatsApp number. Write down your question, and we are joined by our experts today, Sharmila Joshi, Kunal Botra in the studio, who will be answering all of your questions. Before I go on to my WhatsApp question, Sharmila, quick take of the market today. It's trying to recover. How is the breath?
Yeah, I mean, what we are trying to see is that your market is trying to overlook what is happening with crude, etc. So that can last only till that picture, you don't get very negative news from there. So I would really trade very carefully because there have been stocks which have made significant up moves in the interim. You could see corrections deepen there if the situation were to worsen. So I think you need to play it by the ear for the moment.
All right, let's take the first WhatsApp question. This is coming in from Sunny Gupta and it's on HDFC Bank. Entry price is 780. Kunal, there is no time horizon mentioned, but assuming it's a short-term trade, what would you recommend?
See, I think you should hold on to the stock as of now. It's a top quality name, of course, going through a tough time in the last 6-8 months or so for HDFC Bank. Comparatively, the stock has been flatlined over the last many years. We look at HDFC Bank in 2021-22, the stock was placed at 750-800 levels. Currently, also the stock is placed at 750 mark. Generally, we've seen that when stocks go into 4-5 years of a time-wise correction, the potential next 3 to 4 years, the stock tends to reward quite well. So my assumption is that you're looking at this as a long-term time frame. I think it's a good stock to hold on to. Of course, tough times, but if possible, then look to average further for the stock on the downside. Say closer to 700, 720 could be a first level of a major support for HDFC Bank over the medium to long term.
Right. So the next name in focus today, that is Apollo Microsystems. We've got this query from Mr. Venu from Hyderabad. So Apollo Microsystems is the stock in focus, and they're asking if this is a good time to fresh buy for the short term. Sharmila, can you just tell us how you're seeing this stock?
Honestly, I like the stock. I don't know about buying at the current price. What I would really recommend is that, you do a sort of an SIP and buy every dip that you get or so. But overall, I think, given the fact that this is in the defense space and it's a space that is going to remain in focus, you could look at the stock. But as I said, try and stagger your buying.
All right. So sort of a thumbs up on the fundamental aspects for Apollo Microsystems, but at an entry price of 385, Kunal, do you think this is a smart time to enter at this price?
It's a good price to enter the stock price because the stock at 380-ish levels, I think, is also showing signs of major support for the stock price in the very near term. So it's been guiding into a range of 350, 370 as a major support, and then closer to 450, 470 as a band of resistance. So I think in that sense, it's a good price or entry point. But my only sense is that if the stock has to cross the levels of 415, 420, for a new momentum trend to start to seep into Apollo Microsystems. What's been happening is that in the last 2-3 months or weeks of this price correction, the stock seems to have, the indicator seems to have come back into a neutral territory. So you might see more of a lull kind of a price action over the near term, but once the stock breaks 415, 420 mark as a barrier, that could probably perk up the momentum for Apollo Microsystems.
Perfect. Next is the long-term question. Sharmila, I'll come to you. This is from Meher Chand from Visakhapatnam. And Meher has bought 70 shares of Syrma SGS at 944. It's a long-term view. Wants to know the strategy ahead.
Yeah. Overall, I think that, yes, I think this is definitely a stock you can hold on to. The valuations seem reasonable. This is the sector that I like. You may not see it move meaning at the moment, sort of the outlook is a little neutral, given their earnings, etc. But I think that if you are a longer term investor, you should stay invested.
Right, so stay invested on Syrma SGS is what we're seeing, is the signal that we're getting in. But the next question is from Ramesh, coming in from Delhi. The stock in focus is Motherson Sumi Wiring. Ramesh is asking if he can add more at this current level. He's currently holding about 4,000 shares at an entry price of 43. Kunal, what's your take on this?
Not so just to add further for the stock price, it's still trading at 40 rupees. The recent high for the stock was around 42, 42 and a half approximately for the stock price. There is lack of momentum for Motherson Sumi Wiring. If you're looking at this as a long term, then maybe closer to 37 and a half, 38 levels is a better price point for you to enter or maybe average further for the stock.
Okay. Next question is coming in from Girish Iyer from Trivandrum, and Centum Electronic is the stock. Buy price is 3045 and wants to know the upward scope in short term, or should he be booking his profit and exiting? Kunal, an exit strategy or a part profit book strategy?
So as of now, part profit booking strategy, but keep a trailing stop loss of the previous lows around 3450 mark for Centum, because the stock so far has been trading at good support above the 50-day moving average. It tends to just about go into a rally, mean revert back towards the 50 DMA and then continue to move up higher. So, just in case if the stock goes into a drift down and assuming if it falls below the 50-day moving average, prior to that, I would suggest to book partial profits at the current levels of 3600 plus, keep 3450 as a trailing stop loss. In case if the stock drops below 3450 mark, I would suggest to book full profits with the balance quantity which you have. And then on the downside, the major support for the stock is at 3000, which coincides approximately to the long-term moving average for Centum. So I think closer to the 3000 levels is where you can look to rebuy the stock.
All right, so the levels highlighted for Centum Electronics where we can rebuy. But the next question coming in from Manyata from Mumbai. She's got an allocation of SBI Fund IPO. Should she be booking listing gains or holding? First of all, congratulations on getting a listing of the IPO. Sharmila, what do you think? Should she be holding?
Yes, I think she should continue to hold simply because the SBI mutual fund is India's largest mutual fund. So they are sort of first in that space. Also, I think overall, if my theme is to stay positive on anything that is sort of capital market facing, given the fact that we are seeing more and more people sort of investing in the markets, whether it's equity or bonds, and the SIP route, we know how much money has gone, how much money people are beginning to allocate to SIP. And I think, given our demographics, given our population, there is still a long way to go. So I think all mutual fund companies will benefit from that. And being the leader, definitely SBI Fund Management. We do see stocks correct after listing, but I think if you're a longer-term investor, you should definitely stay invested.
Long-term investor, stay invested. Let's move on. Other question is coming in from Venkat, and Venkat wants to know about two stocks. One is Sharda Cropchem, wants to buy at the current price, and Waaree Renewables bought at 605. Kunal, what's going to be your take for short-term, both of them, and entry price for Sharda Cropchem?
See, for Sharda Cropchem, I would not suggest a buy at the current levels. The two reasons. One is the stock has shown signs of a bearish crossover where the medium to moving average 50 DMA has crossed below the 200-day moving average. That generally indicates that we could be looking at a series of lower highs and lower lows for the stock price. The second critical part is that the stock on the weekly charts is nearing a break of a major and critical support. And with the weakness on indicators, there is a high probability that the weakness may continue for the stock price in the near to medium term. So I would suggest and avoid on the stock price, at least as of now. Let this correction pan out, say over the next 5-7 weeks. Maybe I think once the stock corrects by another 10 odd % is where there could be better price points which could emerge for the stock. So as of now, and avoid. For Borosil Renewables, I think it's a decent chart in the making. The stock has gone through a very strong rally from the March lows. It was almost at sub 400 levels and now recently made a high of 650. So a decent 50% rally for the stock, going through a mild mean reversion. But if you've purchased at slight higher levels, I would suggest closer to 550, 560 zone is where you should look to average further.
All right, so that's the take coming in on Sharda Cropchem and Borosil Renewables. Our next query coming in from Parth Bhattacharjee, coming in from Durgapur. Now, Parth has bought Varun Beverages at a price of 530 and is looking for future strategy along with a target price for the next 3 months. Kunal, what's your take on this? Do you see any further upside from these levels?
Yeah, I sense so, because I think Varun Beverages is a slightly high beta stock, so you'll have to be cognizant of the fact that the stock could swing by 15%, 10% in a very short span of time. By short span of time, I mean 3-4 weeks. That's been the tendency for Varun Beverages over the last many years. Now, interestingly, what's happened is that the stock has corrected recently from those 520, 550 levels to 460, where it's trading right now. So again, that 10% correction seems to have played out for Varun Beverages, and that's why the risk reward could be slightly better at the current levels. Now, there could be a contra opinion over here because FMCG stocks overall have not performed quite well, but then it's cyclical sector rotation wise that maybe over the next 1 to 3 months, there should be a possibility that FMCG stocks can make a very strong comeback. In that anticipation, and with a slightly better risk reward, I would suggest a buy on Varun Beverages at the current levels.
All right, it's a buy at the current levels in Varun Beverages. But with that, it's time for a short break, and post that, we are still answering your stock-specific questions. So stay tuned and keep sending us your questions.
Welcome back. You're watching Buy Now, Sell Now, and we'll just jump right back into your WhatsApp queries. The next one is from Bhiksha Maya from Hyderabad, and the stock in focus here is Supreme Industries. The quantity is 155 shares that they've acquired at an entry price of 1,730. First of all, congratulations on that profit that you're sitting on. Now they're asking that they're a long-term investor, and since it is a technically weak stock right now, they're asking for a hold or a sell call. Kunal, what do you think? Should they hold on to these shares or sell right now and book profits?
I would suggest or recommend a hold on the stock price. Yes, it's a tad bit weak on the charts because of the recent last 2 years of price correction. Supreme Industries was a stock which was trading or cruising at 6,000-ish levels in 2024. And from there, the stock has corrected almost 40-45% towards 3,400 mark, which was the recent low for Supreme Industries. So a major part of the pain now seems to be behind. There could be a possibility that the stock may go into a time-wise correction. What happens many a times is that when stock prices go through a initial damage in terms of price correction, then follows maybe a couple of quarters of a sideways range, for the stock price. Volumes tends to increase for the stock at those price points, but then gradually the stocks form a bottom for themselves. I would believe that potentially over the next 1 to 2 quarters, the stock may exhibit this kind of a pattern. It may be stuck at this 3,400 levels, but since you're a long-term investor and you've purchased at lower levels, I would suggest to hold on to the stock, assuming that your further time frame is at least 1 to 2 years.
But he's also making profit of more than 260,000. So a part profit book strategy maybe?
Not really, Kavita, because I would sense that the stock still has much more room on the higher side to go from a long-term perspective.
All right, let's get a live viewer on the phone line. This is Mr. Rajendran on the phone line from Bangalore. Hi, good morning.
Yeah, good morning.
You can ask your question, sir.
Yeah, my question is to Kunal, if you don't mind.
Sure.
I had picked up Dixon Technologies at the rate 14,224, and currently it has gone down to 13,950. The total quantity is 50, which I bought. I want to know whether I need to wait for some time or take an exit and buy something else, and what else would you suggest if I had to take an exit?
Okay, that was Dixon Tech. RVNL also?
Yes. I had picked up RVNL also, 1,000 quantity of RVNL
Yeah.
at the rate 315, which has gone down to 225. Okay, so is it risky for me to hold on, or can I take an exit and concentrate on something else?
Sure. Kunal?
See, I'll start off with Dixon Tech first because I would actually sense that Dixon Tech is a very, very improving chart. The stock has recovered 30-40%. You may have purchased at a slight higher end in terms of the price trends, but I would still suggest to hold on. Now, there are two things which have happened for Dixon Tech. One is that the stock has crossed above its long-term averages, which I believe is very positive for the stock in the medium to long term. The second is that there has been a golden crossover where the 50 DMS crossed about 200-day moving average, which means trends will start to improve for Dixon Tech on the medium to long term basis. In the process of when stocks go into a rally, there is always a mean reversion where the stocks come back to their cooling point or the mean points. I would sense that maybe the further correction could happen for Dixon Tech in the near term. The mean reversion is not yet completed. Maybe the stock can drift down towards even 13,000 mark on a slightly bearish case scenario. I would suggest that closer to 13,000 levels, you can look to average out so that your net cost price drops down significantly. And then there could be a strong possibility for the stock to perform very well on the upside. For the other name, RVNL, the thing is that the stock has already gone through a major correction from a point of 600, 650 in 2024. It's almost at 200. So I think since you've bought at 300-ish odd levels and a major part of the pain is now seems to be factored into the stock price, I would suggest to just hold on to the stock. Watch this for another couple of quarters. Maybe the stock may just languish at this zone of 200, 250 for the next couple of quarters. But there could be a potential turnaround over the next 1 to 2 years for the stock price.
All right, so that's the word coming in. Hope that solved your query. The next question is from DL Narayan. They're asking, and the stock in focus is Sagility. They're asking if they should buy more, sell it, or switch. They're currently holding at an entry price of 45 rupees, and they're holding like 1,000 shares. Kunal, what's your take on this one?
See, it's a stock which has a limited chart history just over the last 2 years or so for the stock. In the last 2 years, approximately, the stock has exhibited strong price levels. 38, 39, for example, is a huge support where the stock seems to be suddenly coming back into a strong demand zone. Volumes improve, indicator starts to bottom out for the stock. But on the higher side, there's a huge supply for the stock at 54 to 58 zone. I would suggest that hold on to the stock as of now. If you're looking to purchase, I would suggest that 38 could be a good price point where you can accumulate further for your time horizon, which could be at least 6 months to 1 year plus.
Perfect. Let's move on. Other WhatsApp question is coming in from Rahul Makana, and the stock is Oracle Finance. Kunal, the entry price. Okay, so the quantity is 10, and he says that there's a fall in the stock even after good results. He wants to know if he can hold or average this one out. I'm still looking at the buy price. I'm not sure if he's given us the buy price on this particular counter, but yes, 11,000, I'm sorry. Okay, yeah, so what's going to be the take?
See, it's a fantastic chart. I've seen this and I've tracked the stock over the last 3-4 months or so from the point when the stock was at, I think, at 6750 or 7,000-ish levels, when the stock had formed a bottom towards 11,000, 11,500, which was the recent high for OFSS. The stock has done fabulously well. One of the only few stocks in the mid-cap IT names which has given such kind of a price performance, and especially in the last 6 months or so, when the narrative for the IT and the IT-related stocks have been extremely pessimistic. Yes, it's gone through a last 2 days of price correction, but then many a times we see this that stock prices move ahead in the anticipation of results. Once the results come out, these stocks go into a profit booking. maybe over the next 1 week, the stock may drift lower towards sub 10,000 mark also. But I would suggest to hold on to the stock from that near-term perspective, try and absorb this round of volatility. And then on the higher side, I would suggest that there could be a possibility that over the next 1 to 3 months or so, the stock may make a comeback and retest the levels of 12,000. That could be a better price point where you may look to book profits.
Right, so a comeback on the horizon for Oracle Finance in the next 1 to 3 months is what Kunal has said is on the cards for this stock. But the next question is from Shankar Prakash, and the stock in focus is Shyam Metallics. He's asking if he can expect a 10 to 15% return from now for the next 12 months. And his entry price for the stock is 825. He's holding about 445 shares in this stock. Kunal, do you see this happening for this stock?
See, long-term charts are very strong for Shyam Metallics. The stock has recovered just in 2026, for example. It's recovered from 750 levels to 1,000 plus. Hitting those 1,000 plus mark makes the stock confirm a multi-year swing high. That too in an environment where the indices and large cap names are struggling. So I think in that sense, the long-term charts are quite strong. My only concern is that with this recent price rally, what has happened is that the indicators are into a tad bit overbought for Shyam Metallics, and the stock is a little erratic in terms of volumes, because there are many days when you see volumes being very strong, the stock moves up higher, but then when the stock goes into a correction, the volumes tend to drop down significantly for the stock. So I would suggest to just wait on for the stock to complete a phase of this mean reversion or a slight cool off. There could be a better risk reward which could originate at 950, 970 levels for Shyam Metallics. So you may want to wait out for those retesting of the mean reversion points and then try and look to buy or maybe add further.
Next question. This is from Chetan, and stock is CF Commercial. Okay, wants to know if it's good to hold. 2698 is the buy price. Kunal.
So I would suggest to hold on to the stock. Maybe even look to average out for the stock at 2300, 2350 levels. The stock seems to be forming a good base. There is a trend line support for the stock, starting from 2025 lows when the stock was at 2150, 2200 levels towards the current or the recent low of 2300 mark. I think the stock has come back or tapped back into a strong support territory. Would suggest a hold, and if possible, just around the 2300 mark could be a good price point where you may look to even average further.
All right, so the 2300 mark specified as a good point to average when it comes to this stock. Thank you, Kunal, for all of that advice on all of the stocks and the queries that you've gotten.
Thank you.
With our viewers, we're completely out of time on this edition of Buy Now, Sell Now. But stay tuned to ET Now for more market headlines coming your way right after this very short break.